All right, today we are going to move way beyond just simple stock picking. We're going to build a professional grade trading plan from the ground up. You're going to see how a pro analyst figures out not just what to buy, but more importantly, why they're buying it, when the timing is right, and exactly how to execute the trade for the best possible outcome.
Okay, so this is our blueprint. It's the 5-step process that every professional follows. We'll start with the basic framework. Then we'll dive in and check the company's financial health, we'll pinpoint our timing, map out the execution, and finally build a solid system for managing our risk and, of course, taking our profits. So, let's get started.
So, first things first, we need to ask the one question that really separates amateur speculation from professional strategy. The difference might seem simple, but truly getting this is the foundation for any kind of consistent success in the market.
Most investors make one huge, critical mistake. They just assume that a great company is always a great investment. A professional knows that is absolutely false. A world-class business, if you buy it at a ridiculously high price, is still a losing trade.
So what's the difference maker? It all comes down to a disciplined plan. This plan, it's the bridge that connects a good company to a profitable trade. It has to cover the why, the when, and the how. This is how we turn quality into actual profit.
And to make this all practical and not just theory, we're going to use Amazon as our case study. We're going to build a complete trading framework for it right now based on its market data as of November 18th, 2025. All right, let's get into it. Our first checkpoint is fundamental strength. Before we even think about looking at a single price chart, we have to validate the quality of the business itself. This is the why. It's our justification for putting our capital on the line. Just look at this number, 144%. Amazon's trailing earnings per share have absolutely exploded by that much in just 21 months. Folks, that isn't just growth, that is hyper-acceleration. It's the first clear signal of some really powerful momentum.
And to put that into perspective for you, this chart shows that Amazon's earnings are growing nearly 5 times faster than the S&P 500. This kind of outperformance proves the company's success is its own. It's not just riding a strong market wave.
So to wrap up our fundamental check, it's a clean sweep. It's got a high Zacks rank, which is a big deal for institutional sentiment, and that's backed by 11 recent upward earnings revisions from analysts. You combine that with massive daily trading volume, and yep, we've confirmed the robust fundamental strength we need to see to even consider moving forward. Okay, so the why is firmly established. The company is solid. Now, we can shift our focus to the tactical question, is now the right time to buy? Remember, a great company is only a great trade if the timing is on your side.
And right now, we're actually seeing a tactical opportunity develop. There's been a recent 4% pullback, which has created a much more attractive entry point than what we saw just last week. This little bit of short-term weakness inside of a long-term uptrend, well, that's exactly the kind of setup a professional loves to find.
Now, this is really important. It's not just that the price dipped, the company's valuation has actually improved. Amazon's price-to-earnings ratio has compressed by 37%. So what does that mean? It means its earnings have grown way faster than its stock price, making the stock fundamentally cheaper now than it was before.
Our analysis here identifies a really key valuation zone. Sure, the current price is attractive, but if we see a dip down into that 212 to 215 range, that would represent an exceptional buying opportunity. At that level, the valuation becomes incredibly compelling.
All right, now for what I think is the most critical component, turning all this analysis into a precise, actionable plan. This is the how. This is the step where discipline is everything, and frankly, it's where most traders fail.
For this case study, we're going to use what I call the moderate strategy. I personally prefer this approach because it gives us a fantastic balance between capitalizing on the opportunity and managing our risk in a disciplined way. The strategy has 4 clear steps. First, we scale into the position with 2 separate entries to get a better average cost. Then, we set a non-negotiable stop loss to protect our capital. Finally, we define our profit targets before we even buy a single share. This whole thing is designed to make our exits completely mechanical and free of emotion. So here are the exact levels for our plan. We'll start with 50% of our position near the current price of $224. Then we're going to place a limit order to buy the other 50% at $218 to take advantage of any more weakness. And most importantly, we set a hard stop loss at $208. If the price hits that level, our thesis is broken. We exit the trade and we protect our capital. No exceptions, no second guessing.
And finally, we define the end game. A professional always knows their exit strategy before they even enter a trade. This plan lays out a mechanical process for taking profits and managing the position as it moves.
These are our profit targets. As the stock hits each one of these price levels, we mechanically sell a preset chunk of our position. This forces discipline. It locks in our gains, and it prevents greed from turning a winning trade into a loser.
You see, this entire plan is built around one thing: quantifiable risk. Based on our average entry price and that hard stop loss, the maximum planned risk on this trade is just 5.88% of our capital. We know exactly what's at stake before a single dollar is ever committed.
And here's the other side of that equation, the reward. For every single dollar we risk, this plan is structured to potentially return $2.44. A risk-reward ratio above 2 to 1 like this, that is the hallmark of a professional trade setup.
Now remember, the price levels for Amazon, those are just an example. They're temporary. The framework is what's universal. The real takeaway here is this repeatable process. For any trade you ever consider, you have to define the why, the when, and the how. That's the only path to long-term consistency.
This is how you transform hope into a concrete strategy. This is how you replace emotion with discipline. So the final question I'll leave you with isn't if you need a plan, but rather, what's in your trading plan?